Welcome back to Mia Wealth Hub, your go-to destination for all things personal finance. In today's video, we're diving into the psychology of investing, specifically, the most common behavioral biases that can negatively affect your financial decisions. These biases can lead us to make mistakes, even when we know better. Let's uncover these biases and learn how to avoid them to make smarter financial choices. Investing isn't just about numbers, it's about psychology too. In fact, many of the decisions we make as investors aren't purely logical or based on facts. Instead, they're shaped by our emotions and mental shortcuts. These mental shortcuts are known as behavioral biases, and today, we're going to cover some of the most common ones that impact investors like you and me. Overconfidence bias. Let's start with one of the most prevalent biases: overconfidence bias. This happens when investors overestimate their ability to predict market moves or pick winning stocks. If you're constantly thinking that you can beat the market, you might be more likely to make high-risk decisions based on a false sense of certainty. Overconfidence can lead to taking excessive risks, like concentrating your investments in a few stocks or making frequent trades. The reality is, even professional investors can't always predict the market, and no one can time the market perfectly. To counteract this bias, focus on diversification and creating a long-term investment strategy. It's also important to regularly review your portfolio and make adjustments based on your goals, not just your gut feeling. Loss aversion bias. Next up is loss aversion bias. This bias occurs when investors are more focused on avoiding losses than pursuing gains. In fact, research has shown that the pain of losing money is about twice as powerful as the pleasure of making money. Loss aversion can cause investors to hold on to losing stocks for too long, hoping they'll rebound, even when it's clear that they won't. It can also make you overly cautious, causing you to miss out on valuable opportunities. To avoid falling victim to loss aversion, focus on setting clear goals and sticking to your investment strategy. It's important to remember that not all investments will always be profitable, and a well-diversified portfolio helps you weather losses without panicking. Herd mentality. Now, let's talk about herd mentality, a bias that makes us follow the crowd, even when we know it might not be the best choice. When everyone around you is investing in a hot stock or cryptocurrency, it's tempting to jump on the bandwagon, thinking you're going to miss out if you don't. But following the herd can lead to making decisions based on emotion rather than logic. You might find yourself buying into an investment just because it's popular, without understanding its fundamentals or how it fits into your financial goals. The best way to avoid herd mentality is to stay informed and make decisions based on your own research. Just because everyone else is doing it doesn't mean it's the right move for you. Stick to your investment strategy, and don't chase trends. Anchoring bias. Another common bias is anchoring bias. This occurs when you base your decisions on a specific piece of information, often the original purchase price of an asset, and you fail to adjust your thinking as new information comes in. For example, if you bought a stock at $100 and it's now trading at $50, you might think, "I can't sell this at a loss." However, you should be considering current market conditions and future potential, not just your original investment price. To avoid anchoring, remember that prices fluctuate, and it's important to evaluate investments based on their current value and future potential, not just how much you initially paid for them. Confirmation bias. Lastly, let's talk about confirmation bias. This is when you search for information that confirms your existing beliefs or opinions and ignore anything that contradicts them. It's natural to want to validate your decisions, but confirmation bias can lead you to overlook risks or red flags. Imagine you're invested in a stock and you start looking for news articles or reports that support your decision while ignoring the warnings. This could lead to poor investment choices and missed opportunities to adjust your strategy. The key to overcoming confirmation bias is to actively seek out opposing viewpoints and unbiased information. Challenge your own assumptions and be open to changing your investment strategy if the facts support it. So, there you have it: overconfidence bias, loss aversion, herd mentality, anchoring, and confirmation bias. 5 common behavioral biases that can cloud your judgment as an investor. By understanding these biases and actively working to avoid them, you'll be in a better position to make rational, informed financial decisions. Have you ever fallen victim to one of these biases? Let me know in the comments below. I'd love to hear your stories. If you found this video helpful, be sure to like, subscribe, and hit that notification bell so you never miss out on more tips from Mia Wealth Hub. Thanks for watching, and I'll see you in the next one.